Hello and welcome to AI Market News by LM. Before we dig into the markets today, just a quick word about how this briefing is produced. We need to share this mandatory readout. This video's audio is automatically generated by NotebookLM, an AI-powered tool. The reference sources used in this summary are listed in the video description. As this content is AI-generated, there may be errors in proper names, pronunciation, or unnatural speech. And importantly, this video does not provide investment or trading advice. Please make investment decisions at your own discretion. Okay, so our mission today is to give a concise, structured deep dive into the global markets. It's Tuesday, October 28, 2025. We're really zeroing in on macro sentiment, key currency pairs, and what's happening in U.S. and Asian equities. It's a huge week with central banks and diplomacy in focus. Let's unpack the mood.
Well, the mood right now is, I'd say, broadly enthusiastic. We're pretty firmly in what the market calls a risk-on environment. Assets are being pushed higher almost across the board.
And based on the prepared resources, that optimism really stems from two big things, doesn't it? First, seems like there's clear easing in U.S.-China trade tensions. That's a big psychological boost.
Huge. And second, the market is almost completely convinced the Federal Reserve is going to act this week.
Yeah, the FedWatch tool basically shows it's a done deal, right?
That's right. The market is pricing in near certainty. We're looking at a highly anticipated 25 basis point cut at the FOMC meeting tomorrow, Wednesday, October 29th. And there's more easing expected in December, too. The real question isn't if they cut now, but what kind of language comes with it.
That language is key, definitely. I mean, the market's already flying high. What if the Fed cuts, but then sounds, hawkish? Maybe signals some hesitation about 2026? Are we maybe getting ahead of ourselves pricing this in so strongly?
It's definitely a high-stakes situation. The path for 2026 is, frankly, very uncertain. You've got potential issues like U.S. government data blackouts that could cloud the picture for the Fed. Plus, there are some serious labor market risks kind of lurking beneath the surface. We're hearing news about potential corporate restructuring. Amazon, for instance, possibly cutting up to 30,000 jobs.
Wow, 30,000. That really highlights the tension, doesn't it? Tech strength pushing stocks up, but major companies shedding jobs.
Exactly. It's a conflict, maybe AI adoption, maybe belt tightening, but it's certainly not a signal of broad economic strength.
No, definitely flags risk. And this market optimism, it's so strong we can actually see it reflected in safe haven assets, right? Like gold.
Absolutely. Gold, for example, recently slipped below the $4,000 per ounce level.
$4,000. Is that just a nice round number, or is it technically important?
Oh, it's highly significant. It acts as a major psychological level and also technical support. Holding below $4,000 really signals less demand for defensive assets. Investors feel comfortable taking risks elsewhere, largely thanks to the progress on trade.
Okay.
But we need to be vigilant. This whole rally could turn on a dime if that U.S.-China trade deal falls through. It's being finalized now ahead of the leaders' meeting Thursday. That's the key risk indicator.
Got it. Let's connect this macro picture to the currency markets. Asia seems to be dominating the story there, particularly the Japanese yen.
Indeed. The yen has been, notably weak, recently trading around 152.7 against the U.S. dollar. And this weakness, it's been a real gift for Japanese exporters, directly helping push Japanese stocks to those record highs we'll talk about.
Yeah, and what's fascinating, based on the input sources, is the U.S. reaction, or lack thereof, to this weak yen. Apparently, after a meeting between the Treasury secretaries, the U.S. basically praised Japan's expansionary policies. Sunninomics, they're calling it.
That's the term, Sunninomics. It refers to the current Japanese government's pretty aggressive fiscal stimulus plan. Lots of spending to boost growth. By praising that, the U.S. Treasury effectively avoided criticizing the weak yen that resulted from it, which is a big relief for Tokyo. It signals currency friction isn't top of the agenda right now.
Interesting. But despite that sort of official, the yen did strengthen a bit on Tuesday, didn't it? Moved back into the, 151.76 to 152.02 range.
Yeah, a slight appreciation, about 0.6% to 0.7%. It looks like it was supported by a dip in U.S. long-term yields. It just shows, even with policy alignment, daily FX moves are still very much tied to U.S. rate dynamics.
Right, and looking longer term, I saw Goldman Sachs as a pretty bold call.
They do. Some strategists there are suggesting the yen could actually revert all the way back to a 100 against the dollar over the next decade.
Wow, 100.
Yeah, the thinking is that Japanese monetary policy will eventually have to normalize, catch up with the rest of the world. It's a powerful long-term bet on the Bank of Japan eventually raising rates significantly.
Okay, let's shift over to Europe, your USD. What's the story there with the ECB?
Well, Eurozone consumer inflation expectations. For the next 12 months, they held pretty steady at 2.7% in September, and the ECB's main rate is 2.15%. So that steady inflation outlook basically supports the bank just staying put for now.
Holding pattern.
Holding pattern. And the sources suggest economists expect that to last quite a while.
Yeah, the general expectation seems to be the ECB keeps rates unchanged probably until 2027.
2027, wow. That's a long time for stable or maybe stagnant rates. That lack of movement must be creating some interesting opportunities maybe in carry trades.
It is, and here's a really curious one we're seeing. Japanese retail investors are apparently piling into short positions on the Swiss franc against the yen. Record high selling of CHF JPY.
Huh. CHF against JPY. That feels like an unusual pair to target so heavily. Why that specific cross?
It boils down purely to the interest rate difference, the carry. The Swiss National Bank rate is zero, flat, 0.00%.
Meanwhile, the Bank of Japan rate is 0.50%, and the market expects it might rise further. So the logic is simple. Sell the zero-yield currency, the franc, and buy the one with the higher, potentially rising yield, the yen. Capture that difference.
Makes sense on paper.
It does, but what's crucial and kind of a warning sign is that these carry traders have actually racked up losses this year doing this. It just shows that geopolitics or sudden currency swings can often blow up strategies based purely on rate differentials.
Good point. Okay, let's pivot to equities. High-flying equity markets starting in the U.S., records being set just ahead of this week, fueled by that trade optimism and the Fed hopes.
The momentum is definitely there. S&P 500 futures holding slight gains. Dow Jones, NASDAQ both strong. And we're seeing two really big corporate stories that kind of capture the current market move.
Right, first the AI chip war is heating up. Qualcomm shares jumped, what, over 11%?
Yeah, huge move. They unveiled new chips aimed squarely at the AI data center market. That's NVIDIA's turf, so a direct challenge.
Serious competition emerging there. That's a big structural shift.
It is. And then conversely, you have the Amazon news. Those potential job cuts, up to 30,000 employees.
Yeah, that juxtaposition is stark, isn't it? Record stock highs driven by tech advances, but massive job cuts potentially driven by some of those same efficiencies or restructuring sends very mixed signals about the labor market's health underneath.
Deeply conflicting signals, exactly.
Okay, shifting across the Pacific. Japan. The Nikkei 225 has just been on a tear, broke 50,000. That's a huge psychological level.
Monumental. Happened for the first time on Monday, October 27th. And that rally is completely tied to that weak yen we discussed, plus all the anticipation around the new Prime Minister Takaichi and her stimulus plans.
The rally paused a bit Tuesday, but the excitement's still there. What should we watch in terms of sectors under Takaichi?
Well, based on the policy hints, there's an expectation that maybe the Bank of Japan slows down its rate hike pace. If that happens, it could create some divergence. Investors seem to be betting on defense and technology stocks continuing to lead the way up. The banking sector, though, might lag because higher rates are generally better for their profits.
Okay, defense and tech favored over banks. Got it. Any negative outliers in Japan?
Yeah, we should flag Nidec, the precision motor maker. They're actually being removed from the Nikkei 225 index. There's an ongoing investigation into accounting inconsistencies, and they're facing potentially substantial losses, so a bit of a dark spot there.
Right, important to note. And quickly wrapping up Asia, South Korea had some positive economic news.
It did. Stronger than expected Q3 GDP growth came in at 1.7% year-on-year. Looks like it was supported by pretty robust government spending and also resilient demand for semiconductors, which is obviously key globally. The Kospi index did pull back a little Tuesday, but that might just be some profit-taking after recent swings.
Okay, let's step back now and look at the geopolitical side, especially the big meeting this week. President Trump and Japanese Prime Minister Takaichi face-to-face on October 28th.
Yeah, this meeting seems to have gone beyond just photo ops. Reports suggest it was really focused on strengthening the alliance, especially on defense spending. Japan is apparently committing to increasing its defense budget towards that 2% of GDP target faster than they originally planned. That's something the U.S. has wanted for a long time.
And Prime Minister Takaichi seems to be really emphasizing personal diplomacy, doesn't she? Following the Abe playbook, perhaps. I saw reports she plans to recommend President Trump for the Nobel Peace Prize.
That certainly signals a strong effort to build personal rapport, yeah. Likely trying to smooth over any potential economic frictions down the line.
But the really big takeaway, economically speaking, seems to be that massive investment fund from Japan into the U.S. $550 billion confirmed.
That's the headline number, $550 billion. and the execution is moving forward. A joint fact sheet apparently revealed candidate projects worth nearly $400 billion are already identified.
400 billion identified already. That's a colossal amount. What's the strategic thinking here? Is it just investment, or is there more to it?
Oh, it's much more strategic than just capital flow. Based on the sources, this is about structurally shifting supply chains. The investments are heavily focused on critical areas, things like securing critical minerals and rare earth supply chains, clearly aimed at reducing dependence on China.
Right.
Also investing in energy and power generation, specifically mentioning the needs for AI infrastructure. And even shipbuilding cooperation. Commerce Secretary Letnick apparently noted the first project, likely in the power sector, could even be decided before year-end.
Wow. So this fund isn't just an injection of cash, it's a long-term commitment to reshaping global economic ties, particularly away from China.
Exactly. It represents a significant long-term strategic realignment.
Incredibly important context, not just news for today, but potentially shaping the next decade. Okay, before we wrap up, let's quickly flag the key upcoming economic events we need to watch. Using the investing.com calendar, U.S. time zone, GMT-4 byte 0.
Right. So today, Tuesday, October 28th, we've got several U.S. data points that could definitely move the needle ahead of the Fed tomorrow.
Okay, what should we look out for?
First, at 9:00 a.m. Eastern Time, we get the U.S. House Price Index for August. Then the big focus will be 10:00 OA Eastern. Three key reports drop simultaneously. U.S. CB Consumer Confidence for October, new home sales for September, and the Richmond Fed Manufacturing Index. Busy hour.
Definitely a busy hour. Anything later in the day?
Yeah, later on at 4:30 p.m. Eastern, we get the API Weekly crude oil stock data, always important for the energy markets.
And of course, looming over everything, the main events, the central bank decisions. Fed is Wednesday, October 29th. And then Thursday, October 30th, we get both the Bank of Japan and the European Central Bank. It's going to be a volatile end to the week.
Absolutely. So summing up, we're kind of riding this wave of technical strength and pretty significant political optimism. U.S.-China detente hopes, Fed cut expectations, driving things. But we have to remember these critical technical levels that have just been tested or broken. You know, the Nikkei smashing 50K, the S&P at record highs, gold dropping below $4,000 support.
Yeah, it feels like the stage is perfectly set for some potentially sharp moves around this week's big decisions and data. I guess the biggest question for us to think about, beyond just the immediate Fed decision, is how much these longer-term geopolitical shifts like Japan's defense spending boost and that huge $550 billion strategic investment, how much will they fundamentally reshape supply chains and global economic dependencies over, say, the next 5 or 10 years?
That investment feels like more than just propping up the U.S. economy. It really seems like a down payment on a different global economic structure.
Something to definitely keep watching. Thanks for watching. Don't forget to like and subscribe.